goals, and then in December in Paris, when we had the climate agreement. It's actually the first time in human history when the whole world joins together and experiences this sense of urgency and willingness to cooperate. All countries, poor, rich, and middle-income country groups, as well as all stakeholders, governments, NGOs, private sector, but also citizens and science. Nothing less than the future life on our planet is at stake. And it's also the first time that it's understood that ending poverty must go hand in hand with tackling climate change and protecting the environment. And also with strategies that build economic growth and address the wide range of social challenges, education, health, but also growth of jobs. And what is also clear is that we cannot no longer think and act in silos. And we believe that private investors have a crucial role to play in order to reach these sustainable development goals and the goals set in the Paris Agreement. And at the same time, the SDGs can also serve as a framework for impact investing. It's an inspiration. It's giving a context to impact investing. But not only that, we think that the SDGs can also change the financial industry as a whole, looking to a different lens of what it means to invest and what it means to create real value, and stimulating all investors to think differently. As UN Secretary General Ban Ki-moon says, it's a simple to-do list for people and planet. It's a blueprint for success. Impact investing is about bringing the soul back into money. It's through impact investing that institutional and also private investors can connect to the many entrepreneurs that are currently working in the world through their companies to work for positive change. And there are many inspiring examples of these entrepreneurs here in India. We need to do our utmost to safeguard a sustainable society for ourselves, but specifically for the generations that come after us. And how we invest our money today will define how our future will look like. Thank you very much.
Had the opportunity to meet, to interact with KFW, the German Development Bank. It's the first time I actually got a call, and then was followed by a visit by two people. One of the person was Claudia Schiller, who happened to actually come on a visit to see if Avishkar does do what it claims. After 15-second day, 7 days of rigorous ragging that we received at the hand of Claudia, I actually understood my own impact-making abilities. First time, from an LP's perspective. Let me invite Claudia Schiller, the head of financial sector South Asia from KFW, who actually can safely tell you that we do make impact, if nothing else. But there's a lot more that she will talk about in her address.
Thank you, Monique, for the introduction. Good evening to all of you. I feel very privileged to speak here tonight. I also feel humbled by the stories and personal passes that some of them I know, I just learned. So you set the bar high, I believe, and I'm not sure whether I can actually live up to it. But I'll try. As the panel name suggests, I was asked to share a few thoughts on the dilemma I am experiencing representing an LP. And when I started reflecting on it, I experienced another dilemma, actually thinking that KFW, the development I work for, is not a typical LP. So we are 100% publicly owned. We usually interact with public entities, could be ministries, public utilities, state-owned banks. So we're not a private investor, nor do we usually interact or partner myself, what can I possibly tell you? And I came to some answers, and a few more came to me during the course of today, listening to some of the breakout sessions. I was actually realizing also that we're not so untypical after all. Being in DFI, I've learned that is one of the core investor groups still in impact investing in India. And saying that, I do like actually that we are being not necessarily outcrowded, but complemented by a lot more Indian elements in the future. So what I can do tonight though is to try and give you a view of a development yet market-oriented investor from abroad. As KfW, we do equity investments. For us, they are more the exception than the rule. As I said before, we are a bank, so we're also heavily active in debt. It's actually our core business. When we do equity as an LP, we generally prefer investing in funds rather than into individual companies. And I also like to take the opportunity to introduce you to another DFI. It's actually a subsidiary of ours called DEG. I'm not sure actually whether the colleagues are here tonight. Anyone from DEG in the room? Didn't see them earlier. They're not here. Maybe hopefully we can introduce you to them tomorrow. It's a name to remember. Within KfW Banking Group, they are basically the private sector mandated to support private business. And as a parent, KfW is only complementing their activities very selectively and with a rather narrow focus. We focus on financial inclusion and on what we call social entrepreneurship finance. And to some extent, and if you ask me, growing in the future green investments. So I very much align to what you said earlier, Mary, that is very much on the agenda for us when we think of impact investing. It's not just social, but it's also environmental impact. So now normally I'm stressing the development focus of my work, but I don't actually call it impact investing. I don't actually like the term impact investing, and I was sharing that with Puneet earlier, so he preempted my speech on that. I feel to some extent it's a bit of a buzzword. It can mean everything and nothing. And when I find myself in conversations about impact investing, I usually spend around half an hour trying to define common ground of what it is that we're actually talking about. Usually at the end of such discussions, we agree to not agree on the definition, because there is no perfect definition, or at least none that I am aware of. So personally, I usually try to avoid those theoretical discussions and ask for impact examples. And a short conversation around such examples gives me a pretty good and quick view on the depth of what a company or a fund is looking at and how it distincts itself from conventional business. So, when preparing for this, Puneet was sharing 5 questions with us. And the first question you asked us to comment on was on do we actually see some investment allocation for impact investing? I think the answer depends on whom you talk to. Within KfW, impact is very important. Has always been. It's at the core of what we do. It's actually the very reason why we exist. So to some extent, one could claim that everything we do should be considered impact investing. So you might see a little bit the issue I have with the phrase. If I look at it that way, it's not really offering much guidance for our investment allocation decisions. Now, having said that, I do sometimes, or regularly actually, when I think about it, use the term when talking to financial co-investors. May it be commercial bank, may it be institutional investors. The term is more attractive to them than development finance. So I find it helpful for the marketing discussion there, but then again I end up in those half-hour discussions on the definition. Now, maybe with the exceptions from some very dedicated investors, such as Triadis Bank. I have not come across investors, commercial investors, and you asked that, have really proper volume allocation targets for impact investing. I happily am proven wrong, but it's not generally what I get to see, at least not in a material way outside of corporate social responsibility budgets. And I hope it's something that we can change. I do get the sense that most want to do more. They are attracted by the space, but they take a very cautious approach. And I think that was particularly true for some of the big money that people are eyeing with pension funds, mutual funds. They are certainly intrigued by the opportunity, but the maximum acceptable risk levels, minimum size requirements, liquidity requirements, often do not find the appropriate match in the impact investing world. Hopefully yet. So that is one dilemma that I see, that the available profiles of impact investing opportunities and the guidelines for investors often do not fit as of today. The second question that Vinit asked us to comment on was, what do LPs actually expect from GPs? And I quote, "Is it performance, clarity of thought, track record, commitment to the course, or something else?" Now, sorry for all the GPs in the room. I don't think it's one of them. I think it's all of that, and depending on the particular LP, probably a few more things. To reiterate what had been also discussed in one of the breakout sessions, I think improving impact measurement would furthermore be warmly welcomed by all LPs. It allows us to improve our accountability, and it allows us also to spread the word and bring in other investors with which we are regularly interacting. One element I particularly struggle with personally is, when it comes to impact measurement, is comparability across instruments. I really enjoyed a breakout session today that was actually termed venture debt, a term I'm still struggling to get my head around, but I think that is an important thing in the industry. And it's sometimes underlined, it's very often all about equity. But there's very little guidance on the question, where do I get more impact as an LP? If I put 10 million euro in an equity investment, in the so-called impact investment fund, one option I have, or should I give 100 million euro loan to refinance or a bank for some unfunded social course, for example, affordable housing? Now, I think a lot of specialized funds, and I compliment you on that, you've done a lot more than in 2010. I think a lot of funds do a pretty nice job in presenting impact reports these days. I think they do a much better job than most banks. But when it comes down to investment allocation, to those decisions, should I go for an equity fund, should I go for debt, and very other comparisons that we have to do on a regular basis, I'm still pretty much on my own as an LP. So there is another dilemma. While I'm intrigued by the course, to make those allocation decisions, there is still a lot of judgment involved that is basically down to personal institutional experience. The third question we were asked was on possible or desirable changes of fund structures and fee structures, and you were particularly referencing to the venture capital industries with the closed-ended 10-year tenor fund, 2% management fee, 20% current. I feel the same way as you do. When I thought about where could there be an innovation, and I went through all the features of such equity funds, I'm very uncreative. I pretty much like all those features. And I asked myself, would I want to give away any of it or alter it? I think they're there for rather good reasons. And it really pushes for focus on execution. The one feature maybe I started reflecting a little bit on was less the fee structure that a fund manager receives, but was on the hurdle rate that we usually define as an investor. Now, would a socially motivated lower hurdle rate actually make more possible impact investments financially viable? Certainly, I think it would. Would that actually bring more money into the space? I'm not so sure. And that, I think, there's always a commercial benchmark. And that is it me overdoing on time? There's a screen flashing like crazy in front of me. You can't see it. Okay. You tell me, yeah, if I overdo. There's always a commercial benchmark. And we need to remind ourselves that if we want to crowd in, if we want to bring more money into the space, and we are attracting investors that are not used to it, they will compare to their next best alternative, and that is from conventional finance. So I'm not sure whether actually, playing with those features of the fund will get the attraction in the investor or LP world that we would like to see. Even though it might be nice theoretically to make more projects viable, it may not bring the big money. Having said that, there are different investors out there. Different investors look for different things, and some are way more willing to compromise on financial return than others. So it's, I think, difficult to decide on an industry level, but differences may very well exist on an investment level. But all in all, I'm rather uncreative when it comes to equity fund structures, where I would personally see more innovation, and I think there has already been a lot of innovation, and some really you alluded on, is when it comes to debt vehicles or mezzanine and debt financing in general. There are different fund structures out there. They can be open-ended. There are different structured funds that have different share classes with different risk-return profiles, which can cater to the different needs and requirements of different investors. And for a pension fund, for example, it's probably much easier to invest in a fixed coupon